Paying off your mortgage versus investing. What's smarter after the age of 55? Well, if you're over 55, chances are you've already asked yourself this question many times. Should I rush to pay off my mortgage, or should I put money into investments now and watch them grow? It's one of the biggest financial dilemmas Canadians face today as they approach retirement, because for decades the traditional answer was very clear: get rid of the mortgage as soon as possible, retire debt-free, and that was seen as the gold standard. But today things aren't so simple. It's more complicated. Interest rates can go up and down, markets can deliver big gains or big losses, and at the same time, housing wealth has exploded. It used to be that your house equity was a much smaller component of your retirement equity. So the decision today is far less straightforward than it used to be in the past. In this video, we're going to break it down. What happens if you aggressively pay off your mortgage versus what happens if you invest the money instead? And we'll look at a third option as well that most Canadians overlook: using your home equity strategically as part of your retirement plan. Plan being the key word. So first, just a super quick introduction to myself and this channel. My name is Peter Fabry. I've been licensed as a mortgage broker since 1999, and I'm the founder of Rewind Mortgage, a reverse mortgage information site within my license brokerage. And you can find all the provincial licensing numbers in the details section of the main page. This channel is all about honest, pressure-free education on different financing options in retirement. So if that sounds good for you, hit subscribe. Now let's dive in. Let's start with talking about paying down the mortgage. The logic here is very simple. The less debt you have, the less risk. Retirement without payments and free up cash flow for other things. Psychologically, this feels very safe. You don't owe the bank anything anymore. And in a rising interest rate environment, paying down a 5% mortgage is like getting a guaranteed return on your money. It's very appealing. But here's the trade-off. If you funnel every spare dollar into your mortgage, that's money that you're not investing. So your equity sits locked in your home, growing only at the pace of whatever real estate growth is. And now in 2025, well, that's a negative growth. It's completely inaccessible unless you sell or refinance. And so if the housing market's flat and not growing, and we don't see it growing much over the next little while, there may be other opportunities to invest outside of your home, either financially or in what is important to you, whether that's your health, your happiness, your family. So let's flip it. What if instead of accelerating mortgage payments, you invest? Over the long run, Canadian equities always have averaged about 7-8% annually for a stable, fairly safe return. Even balanced portfolios have often outpaced mortgage interest rates. So the strategy worked very well in the past, especially when interest rates on mortgages were 3% or less. If you can invest and get 7% and borrow at 3%, well, it's a clear win. The math was on your side, but it's not where we are right now. You can't borrow for 3% no matter how good your income and credit is. So what about investing rather than making mortgage payments? Well, if you're investing, that comes with risk. Markets are volatile. If you're 58 years old and the market drops 25%, think the year 2000 tech crash. Think 2007 or 2008, the great financial crisis. Well, if that happens again, and that always happens again sooner or later, you do not have decades to wait for a recovery. So that's why this choice feels very uncomfortable, Canadians, taking money and funneling it towards investments rather than paying down the mortgage. So you've got an opportunity cost problem here. Here's the real issue. Both strategies, pay down or invest, they both have opportunity cost. If you only pay down, you sacrifice growth and liquidity. If you only invest, you carry debt risk into retirement. And so here's where many Canadians get stuck. They want the peace of mind of being mortgage free, but what they really want is being mortgage payment free. They also don't want to miss the growth that investing can deliver, and that requires payment. So here's the third option that comes in: using your home equity strategically. Think of your home the way you used to think of an RSP, especially now when it's such a bigger chunk of your retirement nest egg than it used to be. It's an asset designed to support you in retirement. Through a reverse mortgage, Canadians over 55 can unlock up to 55% of their home's value. Tax-free, unlike cashing in investment where you've got capital gain. So that means you can keep up investing while you free up cash flow without having to consider selling your home. Do you want to make payments? You can. Don't want to make payments? You don't have to. Payments are optional. It isn't a simple case of You're not making payments and the interest is growing. It's up to you. No matter where interest rates go for mortgages, no matter where housing market prices go, you don't have to make a payment as long as you live in your home. But you can. Here's an example. Linda, 60, Burlington, still owes $200,000 on her home. She could spend the next 8 years working to pay it off, or she could use a reverse mortgage, wipe out the payments, redirect her mortgage payment cash flow that she's making now into investments or into lifestyle spending. I mean, that's what it's for, right? You want to be doing what you want to do in retirement. This is very appealing to people that got mortgages during COVID when rates were so low, and now they're seeing renewals coming up where their payments and interest are triple. It's not uncommon for people to be racking up high interest credit cards or lines of credit or taking expensive car loans because all their income's going towards their mortgage now. And they're stuck in the mindset of, gotta pay the mortgage down. There's no other way to do it. If you've got a reverse mortgage, of course you can keep working. It doesn't affect your eligibility for a reverse mortgage. In fact, it's a positive impact on your entire lifestyle. The other thing is everyone knows that if you put off things that are important to you, such as travel, spending time with kids, grandkids, whatever, well, anything could happen. You might be putting off those things and never get to do them. To me, that's a bigger risk than anything because time's worth more than money. I hate it when people say time is money. Time is not money. Time is time. Money is just something that's a measurement of your time that you trade off for your time. So these types of decisions where you're putting things off for later, when you're young, it makes sense. Put a delayed gratification. Try to keep your costs down, try to save. But when you're older, the more you put off, the more it feels like, well, am I ever going to get to not put it off, right? So back to the question of whether you should put money into investing or paying off your mortgage. Well, you really have to reframe the question with a third factor in mind. It's not just paying down versus investing. It's how do you balance debt, growth, and most importantly, your quality of life while using all of the tools you have available. So what's smarter after 55? Paying off your mortgage or investing? Well, the truth is,